morning. Great to have you on the show. And finally, after that 14-month long break, we've made it to a record high. And starting off well as well in the green this morning. I guess the GDP cheer rubbing off on the equity markets. But Manish, what next now?
So yeah, the markets have actually crossed the previous highs of 26,277 seen in September 24. So after 14 months, that's correct. But it does not really feel like that markets have hit a new high with, there's some distance where the mid-cap stocks have still to reach, and there's some distance where the small-cap index is still to reach the all-time highs. So there's a lot of pain in the broader markets. Optically, things look very bright. The banking stocks, etc. These are heavyweights in the index. They are doing all right. But, there is a lot to catch up as far as the broader markets are concerned. As far as the earnings trajectory is concerned, things are chugging along well. And obviously, I believe that next year earnings growth is going to be around 15-16%. 2-year CAGR on 26 and 27 is going to be 13-14%. We should be headed higher on Nifty 50 per se to the extent of 15-16% in the next 12 months. And I think the real cheer in the markets would come when there is some green, some deep green that is seen in the mid-cap index and the small-cap index.
But Manish, when do you foresee that revival to come in? When it will be a more broad and across-the-board move by the markets, and mid and small caps as well will participate?
No, so what is happening is basically money from the secondary markets is moving to the primary markets. The issuances are just too much. Even for the month of December, we are looking at a pipeline of 40,000 odd crores. So, the small cap segment is a very large universe. You have a classification of 1 to 100 in large caps. So whatever SIP flows come in the large caps will get deployed only in the top 100 stocks by and large. On the mid cap, it is basically 1012 to 250. So another 150 stocks will see the flows in the mid cap segment. But the small cap segment is a very large segment. So there's a problem of liquidity. Liquidity is tight in the system and it's a very large universe. That is why it is taken. It's not to do so much with the earnings or the valuation. Valuations have come down significantly for the mid and the small caps per se. But I think this whole thing will get better. The sentiments as well as the prices in the broader markets will only get better once liquidity in the system revives or there's not too much of over-bunching of IPOs that happen on a monthly basis.
Manish, you are penciling in a high earnings growth for the Nifty going into the next financial year. Which are the sectors which are going to drive this earnings growth?
Rate sensitives. Rate sensitives are in a very sweet spot. Anything to do with interest rates, whether it be banks, NBFCs, insurance, you have real estate, automobiles, these are going to be the front runners when it comes to lifting the Nifty 50 to more highs coming into the future, because apart from whatever government is doing to help the growth, the interest rates getting lower in the system, maybe not this December, but in the next policy meet, you could be headed even lower, because India doesn't have a problem of inflation, whether it be the CPI or the WPI. CPI is 2%, WPI is negative. So I think rate sensitives are going to be the massive outperformers going into the next one.
Manish, you believe this time on Friday we might be looking at a pause, that continued pause, because on 1st October we did see a pause coming in.
I mean, see, logically you should see that the rate cut should be there. But given the fact that the currency is depreciating so badly, and given the fact that maybe you will see, further rate cuts in India only after announcements of further rate cuts in the US happen, because you can't keep too low a spread between the US rates and the Indian rates. So maybe this time around you could see a pause. There could also be a probability of a 25 basis point cut. But next time around the next credit policy meet, you could see a definite 25 basis point cut.
Are you looking closely at some of the macro, numbers which are coming in, especially with respect to tax collection, which has been subdued for now? The nominal GDP is around 8.7% for Q2, and that's also, bringing in some kind of concerns as well.
Yeah, I think the problem for the Indian economy is not the real GDP growth rate, but the nominal GDP growth rate, because inflation, achieving a 10% nominal GDP growth is somewhat of a challenge in the current environment. And I think government is doing its bit in terms of helping the demand side of things, particularly when it comes to consumption through income tax cuts or GST cuts or even the 8th pay commission recommendation. These would all come about in the next. It's already implemented, and you'll get the recommendations in the next 18 months. But I think, tax collections has not been that great, but I think they are on course to meet their, full year targets, because if the nominal GDP growth is 10%, your receipts can't be more than 10-11%. That's for sure. So, I think third quarter and the fourth quarter, you'd see heightened economic activity, and that should result in better receipt collections for the government.
So as an investor, Manish, what do you do? Do you ignore what's happening in the primary market? And is this the time to base build your portfolio within small and mid caps? Because by the time money moves back, you won't get these prices too.
Absolutely. I think, what do you do with the new money that is coming in, and how do you deal with this flurry of IPOs? See, all the IPOs are not bad, and neither are they at very elevated valuations. So it is a pick and choose between the primary and the secondary markets. Many of the IPOs are very, very overpriced, and it's basically a listing gain. Those should be avoided at all costs. Some are exorbitantly overvalued. They should be avoided at all costs. But I think a blend of both the primary and the secondary market is where you should look at. I think the main sectors to look at is basically your rate sensitives, capital markets, contra play on IT, because India is an anti-AI play, and overall IT spends in India, including the GCCs, are not going to see too much of a slowdown even in the current AI environment. So even IT is looking good. These are some of the spaces which, according to me, is okay. And keep some money in the portfolio for bullion, 10 to 15%, because of the woes of the US dollar. That should also be a part of one's portfolio. But, we have got to keep a tab on valuations. And I would believe that valuations are the only case of worry as far as the stocks which are listed in the secondary markets or whatever is available. And I would reckon that if you are having somewhat of a bold heart and take a call on the broader markets, mid and small caps, from the next 3 to 5 year point of view, there cannot be a better time than the current situation. Stocks have already corrected 20-25%, more than 60-70% of the stocks have already corrected 20-25%. Maybe give it another 10%, but the upside is similar to what we saw as the upside in 2025 when we would have bought it in 2020. After the COVID, when there's so much of pessimism around the mid and the small caps, guys who have actually bought in and around those times have made a lot of money. Similarly, when you look out into 2028 or 2030 and you look back into 2025, this would have seemed a very good opportunity to build quality stocks at very reasonable valuation.
Okay, and Manish, since you say that now is a good time to start looking at this mids end of the market right now, what is looking good in terms of which sectors could be the ones from the broader end of the market that could do well?
No, sectors is basically generic to both the large caps and the mid caps. Okay, but the mid and the small caps is all about bottom up stock picking. It's highly naive to actually pinpoint specific sectors in the broader market per se. If you were to take a specific sector, it should be from the generic market point of view. And there, I think rate sensitives, IT, capital markets, selectively infrastructure, these are the spaces to look at. Avoidable sectors are the very high elevated valuations on capital goods, railways, defense. These are some of the areas which are still overvalued, should be avoided. But as far as specific stocks, it is all on bottom-up stock picking, very diverse. Each stock, whether it be any sector, has its own nuances, growth parameters. One should keep a tab on growth and valuations in the mid-cap space. That is of paramount importance, apart from the management quality.
Manish, did you say IT? Is that more a bottom-up tactical play, or are you convinced about the fundamentals turning corner?
Yeah, fundamentals are not deteriorating and they are only getting better. I say over the last few quarters, the broader market, we are actually seeing the earnings start to pick up. And on the other hand, the valuations which were deviating one standard deviation mean away from the mean on the upside, is actually also correcting, and you are somewhere close to the 5-year median valuations. So on both the aspects, on the one hand, the lower cost of capital, government incentivizing spending, and your valuations coming down, I mean, that should be a good enough recipe for the entire sector to re-rate. It's only a question of liquidity coming back. Whenever liquidity is very tight, this segment of the market corrects more than what is warranted, and that is currently the situation. System is in liquidity deficit. Once that is taken care of, I think you would have already seen a floor, and we should be headed higher.
Manish, what's your take on autos? I mean, we've seen of late, last couple of weeks, autos also started that rally of participating in it. Do you think that this will be a sustained one, and especially two-wheeler makers?
Absolutely. You speak to all the OE guys. I mean, they like the MHCV has already turned a cycle. 2019 numbers have got crossed. Two-wheelers, in fact, are projected to have a very good second half of this year also, and continued into the full year FY26. And, this is all due to the reduction in GST, because in India, what happens is that whenever you hit the affordability quotient, there is ample demand in the system. And that is exactly what we have seen in previous, the erstwhile excise duty regime. Whenever the cuts used to happen, there was a heightened pickup in demand, and that lasted for many quarters. Similarly, this time around, GST rates getting cut from 28 to 18 as per the demand, and we have seen that in the festive season. That's going to get accelerated. And MHCV also is turning the cycle and is due for an upcycle. So all in all, autos are in a sweet spot, very good sweet spot.
Okay, so autos looking good. But Manish, what is your take on gold and gold financiers, more importantly, given the way the gold prices have been fluctuating? Your take on maybe some of the jewelers or the impact that gold financiers could be seeing?
So, I mean, I think whenever, there is stress in the household segment, and particularly the southern part of the country, you see a pickup in gold financiers. And you have seen some very good growth come in over the last 2-3 years. I think going forward, you should look at maybe something like a 15% sort of a growth, nothing more than that. And in that backdrop, valuations are not very prohibitively expensive. So that's one. And I think increase in basically gold or silver prices increases the LTV value, which basically increases the capacity of the households to borrow more. And even that is basically going to lend a helping hand in terms of increasing the ticket size or maybe top-up loans for the gold financiers. So all in all, not a bad scenario for the gold financiers. Valuations are good, and one should expect a 15% sort of a growth.
Interesting. Okay, Manish, great to have you on the show. Thanks as always for your time.